In the papers today, Carney has given his strongest hint yet that interest rates could rise before the end of the year in a far earlier response to the recovery than expected. The Governor of the Bank of England said there's already been great speculation about the exact timing of the first rate hike. It could happen sooner than markets currently expect. Growth has been much stronger and unemployment has fallen much faster than either we or anyone else expected. Markets forecast the first increase in rates to come in February, so his words raise the prospect of a pre-Christmas increase. And in his Mansion House address, and as part of a move to show the government will take active steps to tackle a property bubble, Osborne announced last night that he would give the Bank of England enhanced powers to ban risky mortgage lending if it fears the housing market is overheating. Under new legislation expected to come into force before the next general election, the bank will be able to set strict limits on lending as a multiple of a borrower's income or as a share of the value of the property, so-called loan-to-income and loan-to-value caps. It comes as the latest LSL England and Wales House Price Index found that prices leapt by 21,000 or 8.5% in the last year to 266,000, the strongest annual performance seen since August 2010. However, if the soaring London property market is taken out of the equation, average prices have risen just 6.3% in the last year. The research also shows a cooling in the market in London, where 12 boroughs saw prices drop in April. Property experts are therefore warning that Osborne's surprise mortgage restrictions could kill off the housing market recovery that is starting to take place outside of London. Paul Smith from estate agency Hart argued that common sense dictates that we ought to see how MMR pans out first and the extent to which it cools the market. And finally, World Cup host nations usually see an economic boom just after the tournament, but research from recruiter Mark Satin predicts that Brazil will only pick up a 4.1% GDP boost by 2016, considerably less than the 6% average of previous tournaments due to a rockier run-up.